You can correctly predict a massive FDA drug approval, watch the stock explode upwards by 50%, and still lose every cent of your options investment. It happens because of implied volatility crush. Before a PDUFA announcement, volatility often spikes over 300%, making option premiums incredibly expensive. Market makers price the options for a perfect outcome, leaving you zero edge. This creates a strictly binary event with no middle ground. If the drug is rejected, the stock goes to zero. If approved, the stock jumps, but usually less than the market makers priced in. But here is the twist that separates pros from gamblers. The money isn't made by betting on the result of the announcement. The real profit is hidden in the weeks leading up to the event. We call this the pre-run strategy. Institutional investors buy rumors and sell news. By entering early, you profit from the rising volatility itself, regardless of where the stock price goes. Here is the exact roadmap to execute this safely. You must exit the position completely before the news drops to avoid the crush. The goal is capturing the fear premium, not the drug approval. Trade the anticipation, never the result.